Today we are going to learn about a trading concept which, if you master it, can completely change your trading style forever. The founder of technical analysis, Charles Dow, presented a theory back in 1900 known as Dow theory, which helped people actually predict what could happen next in the market. Even though that theory is more than 100 years old today, this strategy is still derived from it and is known as multi-time frame analysis. In this video, I will explain how you can analyze charts starting from a higher time frame down to a lower time frame and improve your trading decisions. What is multi-time frame analysis? Multi-time frame analysis is a method where you first analyze the higher time frame and then gradually move down to the lower time frames. In this process, you use three important time frames. 1. Direction time frame. This time frame is used to identify the overall market direction, whether the price is moving upward, downward, or sideways. It helps you understand the overall trend, too. Behavior time frame. This time frame gives deeper insight into price behavior, such as the strength of momentum, market structure breaks, weak rejections or doji candles, whether price is retracing or continuing its move. 3. Entry time frame. This is the time frame where we actually enter trades. If the market is in a downtrend, we look for sell entries. If the market is in an uptrend, we look for buy entries. Now, we explain deeply the direction time frame, behavior time frame, and entry time frame. For completely understanding the direction time frame is the first lens every trader must look through, because without understanding where the market is actually heading, every entry becomes nothing more than a guess. When you zoom out to observe direction, you begin to see the natural flow of price, whether it's rising, falling, or simply moving sideways in consolidation. This is where you develop clarity. A clean trend, whether bullish or bearish, simplifies everything. It helps you avoid unnecessary trades. It saves you from emotional confusion, and it aligns your decisions with the true path of least resistance. When you know the direction, every move you take becomes intentional. Once direction is confirmed, we shift into the behavior time frame. This is where the market begins to speak more clearly. Here, you observe the strength of momentum. Is the market moving with power, or is it slowing down? You read candle behavior. The weak rejections, the tiny bodies, the long wicks, the dojis that whisper hesitation. You notice when structure breaks with confidence and when it breaks with weakness. You learn to feel the difference between a genuine continuation and a temporary pullback. This time frame is where you decode the story behind the candles, where every candle becomes a piece of information that guides your next step. Finally comes the entry time frame, the moment where theory meets execution. This is where precision matters. If the higher time frame tells you the market is in a downtrend, your job is simple. Wait for the market to pull back, show weakness, and give you a clean sell setup. If the higher time frame reveals an uptrend, you patiently wait for price to retrace, show strength, and offer you a clear buy opportunity. The entry time frame is not a place to predict. It is a place to react. You are not fighting the market. You are simply aligning yourself with its flow. When direction, behavior, and entry synchronize, your trading becomes calm, logical, and powerful, exactly the way every trader dreams of trading. Choosing time frames. Based on trading style, the time frames you use depend entirely on your trading style. For example, if I combine intraday and swing trading, I use 4-hour chart for direction, 1-hour chart for behavior, 15-minute chart for entry. You are a scalper. You may use 1 hour for direction, 15-minute for behavior, 5-minute for entry. Now, I will try to explain this. Choosing the right time frames is not just a technical decision. It is a trading identity. Every trader operates differently. Some move fast, some move patiently. Some want big swings, others want quick profits. And because every style demands a different level of precision, The timeframes must match the rhythm of that style. When I combine intraday and swing trading, I choose the 4-hour chart for direction because it filters out the noise. It shows the true heartbeat of the market. Trends on the 4-hour chart are clearer, cleaner, and more reliable. You see genuine swings, not random spikes. This time frame gives you a strong sense of where the market is traveling over the next several sessions, allowing you to stay aligned with bigger movements. Instead of getting trapped in small fluctuations, then comes the 1-hour chart for behavior. This is where the details begin to unfold. The 1-hour chart shows you how the market is behaving inside that 4-hour direction. It reveals the momentum, the structure shifts, the clean pullbacks, the hesitation candles, the weak breaks, the aggressive continuations. Everything that tells you whether the bigger trend is healthy or losing strength. It is close enough to show detail, but wide enough to avoid noise. This is where you decode the intentions of the market before taking action. Finally, the 15-minute chart becomes your entry stage. This is where precision sharpens. You wait for your exact trigger. A clean break, a retest, a rejection, a continuation, a liquidity sweep. This is where you find the best risk-to-reward opportunity. The moment where you step in with confidence because higher time frames have already confirmed the story. Your entry is no longer emotional. It is calculated and aligned with the larger picture. For scalpers, the logic remains the same, but the tempo becomes faster. A scalper uses the 1-hour chart for direction because even a fast trader needs a clean map. The 15-minute chart becomes their behavior frame, showing microstructure and momentum shifts in real time. And the 5-minute chart gives them the razor-sharp entries they need to capture quick, precise moves. Every style has its rhythm, and when your timeframes match that rhythm, your trading becomes smoother, clearer, and far more powerful. Your timeframes must match your style. But these examples show how you can structure them properly. Starting the analysis, we begin with the 4-hour chart to determine market direction. The biggest benefit of this higher time frame is that it reveals the overall market structure clearly. Lower time frames, like the 15-minute chart alone, do not provide a clear direction. Because price fluctuates frequently up and down, many traders become confused when analyzing charts and don't know whether to buy, sell, or stay out. This happens because they clutter charts with too many support and resistance lines based on old data. Instead, we should focus only on recent price behavior. On the 4-hour chart, the market is in a strong uptrend, but currently in a consolidation phase. We mark the high and low of the consolidation zone and wait for price to decide its direction. Price can either continue the uptrend or reverse downward in live trading. We wait for a candle to close outside this zone before deciding whether to buy or sell. Understanding conflicting timeframes when we switch charts. 4-hour time frame gives strong uptrend, 1-hour time frame gives downward movement, 15-minute time frame gives strong downtrend. This seems confusing. Why is the higher time frame bullish while lower time frames are bearish? The explanation is simple. What looks like a downtrend on smaller time frames is actually just a retracement or pullback within the larger uptrend. When you look at multiple time frames, the market can appear confusing at first. On the 4-hour chart, you see a clean, powerful uptrend. Price pushing higher, creating higher highs and higher lows. But the moment you drop to the 1-hour chart, it suddenly looks like the market is falling. Then on the 15-minute chart, the candles look even more aggressively bearish. And you think, how can one time frame be bullish while another is clearly bearish? The truth is, nothing is wrong. This is exactly how the market moves. What you see as a downtrend on the lower time frames is simply the market breathing. A retracement. A temporary pullback inside a bigger, dominant uptrend. Imagine the 4-hour trend as a long road climbing upward. Now imagine the market taking a small step backward before continuing its climb. On the 4-hour chart, that backward step barely looks like a dent. But when you zoom in to the 1-hour or 15-minute chart, that same small pullback suddenly looks like a full downtrend. The internal structure becomes visible. The small bearish waves inside the large bullish ocean become clearer and sharper. This is why multi-frame analysis is so important. The higher time frame controls the direction. It tells you the true intention of the market. The lower time frames simply show the internal movements happening inside that intention. So when you see a 4-hour uptrend and a 15-minute downtrend, understand that the market is not reversing. It is only correcting. It is gathering liquidity, collecting orders, and preparing for the next. Continuation in the direction of the bigger trend. Traders who don't understand this get trapped. They see the small downtrend on the 15-minute chart and panic, thinking the whole market is reversing. But professional traders recognize this as an opportunity. They wait for the retracement to finish. They look for the behavior to shift. They watch for strength returning, and then they enter in the direction of the higher time frame. When you see conflicting time frames, don't panic, read the story. The bigger trend is the main plot, and the lower time frames are just small chapters inside it. Important rule: higher time frames are always stronger than lower ones. For example, the 4-hour trend dominates the 1-hour and 15-minute trends. The 1-hour trend dominates the 15-minute trend. Therefore, we should trade in the direction of the highest time frame. Since the 4-hour trend is bullish, we will only look for buy trades. Entry process on the 15-minute chart. Price is still bearish. So we wait until the market shifts from bearish to bullish structure. We do not enter prematurely. After price retests certain levels and fails to break lower, momentum starts to shift. When the 15-minute chart turns bullish, the 1-hour chart is also bullish, and the 4-hour chart remains bullish. We now have alignment across all 3 time frames. This is our perfect trade setup. Trade plan by entry. At the close of the strong bullish candle, stop loss, slightly below the trend line or candle low target. Previous swing high from the 4-hour chart resistance zone, price then moves upward smoothly, and eventually hits our target, allowing us to book profit. A clean trade plan gives structure to your decision-making. It keeps your emotions out and your logic in. When you take a buy entry at the close of a strong bullish candle, you are not guessing, you are reacting to confirmation. That bullish candle is the market telling you, yes, the retracement is likely finished, and momentum is returning in the direction of the higher time frame trend. Entering at the candle close means you wait for evidence, not hope. You only step in when the market shows real strength. Your stop loss sits slightly below the trend line, or the candle's low, because that is the level protecting your idea. If the trend line breaks deeply, or the candle's low gets taken out with power, your setup is invalid. You are no longer in a continuation. You may be in a deeper correction or a reversal. Placing the stop loss just under those key levels allows you to control risk precisely. It's not too tight to get stopped out by noise and not too wide to hurt your risk-to-reward ratio. It is positioned exactly where the story of the trade would change. Your target is the previous swing high on the 4-hour chart because that is the next logical destination. Markets move from level to level. If the 4-hour chart shows an uptrend, each previous high becomes the next area of interest, the next point where liquidity rests, where price may pause, react, or reverse. Targeting that swing high aligns your take profit with the market's natural structure. You're trading what the chart has already shown, not what you wish to happen. When everything aligns, the bullish candle, it's a protective stop loss, and the logical target price often moves upward smoothly. The retracement ends, the trend resumes, and momentum carries your position into profit. And because your trade was built on structure, confirmation, and alignment with the higher time frame, The move feels natural, not forced. This is how disciplined traders operate. They follow a plan. They respect structure, and they let the market deliver the outcome. Risk management reminder trade based on guesswork or emotions. Always wait for confirmation. Entering impulsively is dangerous and can wipe out your trading capital quickly. No matter how large it is, Final notes this strategy works extremely well for me because I do both intraday and swing trading. But you should always adjust the timeframes based on your personal trading style before using this strategy in a reel. Account, backtest it. Practice. Confirm that it works for you. You liked this explanation. Like the video, subscribe to the channel too. Keep learning free price action trading. Thank you very much.